Hello and welcome to Speedy Finance. In today's video, I'm responding to Gary's economics video about mortgages and who gets rich from mortgages. In this video, he tries to suggest that banks act as middlemen between the rich people who deposit the money and the poor people who need to loan, or in this case, get mortgages from the bank. The bank charges the mortgage holders interest and in turn passes some of that interest onto the depositors or the rich people. However, this is complete and utter nonsense. The content of this video from start to finish is incorrect, and in today's video I'm going to discuss how banks actually operate, how they go about creating money and issuing loans and mortgages. So let's get into it. So just for a bit of background, I studied economics at the University of Sheffield just over 10 years ago now. So in university you're taught the money multiplier method, whereby banks have to keep a certain percentage of their deposits as reserves and they can then lend out the remainder of the deposits. So how this works in practice would be that if an individual deposited $1,000 at a bank, the bank would have to keep $100. It could then lend out the remaining $900. If the recipient of that $900 then went and spent that money on, let's say, a laptop, the owner of the laptop store would then deposit that $900 in a different bank. That bank would have to keep $90 in reserve and it could then lend out $810. This process would repeat itself until that $1,000 has turned into $10,000. So that's what you're taught in university, is that banks create money using the money multiplier method, and in that scenario it's 10 times the money from $1,000 to $10,000. However, even this is incorrect. And in this video I'm going to refer to a Bank of England document which was released in quarter one of 2014, and this shows in detail how banks actually create money and how they go about issuing loans and mortgages. So let's get into it. So this document was released by the Bank of England in quarter one of 2014, and this explains how new money is created and how banks create new money in the form of bank deposits through making loans. I will put a link to this document in the description so you can go through the whole document yourself, but let's have a read through of it here. So commercial banks create money in the form of bank deposits by making new loans. When a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit of the size of the mortgage. At that moment, new money is created. For this reason, some economists have referred to bank deposits as fountain pen money created at the stroke of bankers' pens when they approve loans. And you can see this process is illustrated in figure 1, which shows how new lending affects the balance sheets of different sectors of the economy. As shown in the third row of figure 1, the new deposits increase the assets of the consumer, the extra red bars, and the new loan increases their liabilities, the extra white bars. New broad money has been created. Similarly, both sides of the commercial banking sector's balance sheet increases as new money and loans are created. It's important to note that although the simplified diagram of figure 1 shows the amount of new money created as being identical to the amount of new lending, in practice there will be several factors that may subsequently cause the amount of deposits to be different to the amount of lending, and they'll be discussed in the next section. So yeah, basically the bank just uses double entry bookkeeping to create a credit side and a debit side. So obviously the borrower is given the amount, let's assume it's say £100,000, but then they've also got a debt of £100,000, so that equalises out, and it's just the bank just uses double entry bookkeeping to issue the loan. So in effect, the money is created out of thin air, and this is the main issue with the fiat monetary system, is that banks have the power to create money out of nothing, which in turn causes inflation and devalues the currency, the money that's already in circulation. So yeah, in this description of money creation contrasts with the notion that banks can only lend out pre-existing money outlined in the previous section. So bank deposits are simply a record of how much the bank itself owes its customers, so they are a liability of the bank, not an asset that could be lent out. A related misconception is that banks can lend out their reserves. Reserves can only be lent between banks since consumers do not have access to reserve accounts at the Bank of England. So yeah, this is basically just completely debunking the point that Gary's economics made. He argued that banks act as middlemen, when in reality there's no relation between the deposits and the money that banks lend out. When banks lend money in the form of loans or mortgages, that money is created from nothing, in effect, from scratch. It's not lent from deposits held by the bank. So in that aspect, Gary is completely wrong. However, when the borrower repays the loan, that new money that's been created is in effect destroyed. And this is described in the next section. So just as taking out a new loan creates money, the repayment of bank loans destroys money. For example, suppose a consumer has spent money in a supermarket throughout the month by using a credit card. Each purchase made using the credit card will have increased the outstanding loans on the consumer's balance sheet and the deposits of the supermarket's balance sheet. But when that's paid off, they're both erased. So yeah, in conclusion, Gary's economics is completely wrong. Money is created by banks. That's what the fiat monetary system is based on. It's a bit of a scam in my opinion. If you enjoyed the video, please give it a thumbs up, subscribe to the channel, and I'll catch you in the next one. Thanks for watching.